If you are a property owner above 60, pause what you are doing right now because the IRS just quietly introduced a regulation in 2026 that could cost you thousands of dollars, and most seniors have absolutely no clue it is approaching. I am referring to your residence, your retirement savings, your financial stability. Here is what nobody is sharing with you on the evening news. This new IRS regulation directly targets property owners. And if you do not take the correct measures before the deadline arrives, you could be writing a check to the government that you were never supposed to write. Now, I understand what you are thinking. I have owned my residence for decades. I follow the regulations. This cannot impact me. That is exactly what thousands of seniors stated right before they got caught off guard. Whether you are planning to sell your residence, pass it down to your children, or simply remain put and enjoy your retirement in peace, this regulation changes everything. The good news, there are completely lawful ways to shield yourself, but only if you move quickly and understand exactly what to do. In this video, I am breaking down exactly what this new IRS regulation means for you, who it impacts most, and the 3 simple measures you can take today to shield your residence and your money. But before we get into it, if you know a fellow senior property owner who needs to hear this, press that like button right now so YouTube pushes this to individuals who need it most. Let us look out for each other. So now that you understand what is at risk, let us get into the actual details, because comprehending this new IRS regulation is not just significant, it is absolutely essential for your financial future. And I want you to comprehend every element of this so that by the time this video concludes, you feel confident, educated, and ready to take action. Let us begin from the start. For decades, American property owners, especially seniors who have possessed their residences for an extended period, have benefited from something called the home sale exclusion. This is a provision in the tax code that permits you to exclude a substantial amount of profit from the sale of your primary residence from being taxed. If you are single, you could exclude up to $250,000 in gains. If you are married and filing jointly, that figure doubles to $500,000. That has been the regulation for an extended period, and millions of seniors have depended on it when selling their residences and transitioning into retirement living, downsizing, or relocating closer to family. Now, here is where matters get complicated. In 2026, the IRS, along with new legislative guidance that went into effect this year, has introduced updated regulations around how that exclusion is computed, who qualifies for it, and under what conditions it can be diminished or eliminated entirely. And it is not merely about selling your residence. It also carries implications for individuals who are considering passing their residence down to their children or grandchildren, individuals who have rented out part of their residence, individuals who have utilized their residence as a home office, and even individuals who have taken out a reverse mortgage. In other words, this touches nearly every property owner over the age of 60 in America in some fashion. Let me guide you through the most significant changes, starting with the residency requirement. Under the existing regulations, you needed to have resided in your residence as your primary dwelling for at least 2 of the last 5 years before selling in order to qualify for the exclusion. That sounds straightforward enough, correct? You reside in your house, you sell it, you do not owe taxes on the first $250,000 or $500,000 of profit. But the new IRS guidance has tightened the definition of what counts as a primary dwelling and how that residency period is confirmed. Here is what that means in practice. If you have been spending substantial amounts of time, say several months per year at a vacation residence, a second property, or even staying with relatives in another state, the IRS may now examine whether your claimed primary dwelling truly qualifies. They are examining things like where you receive your correspondence, where you are registered to vote, where your automobiles are registered, where you receive medical treatment, and what your utility and credit card records reveal about where you are actually spending your time. For seniors who snowbird, meaning you spend winters in Florida or Arizona and summers somewhere in the Midwest or Northeast, this is an especially critical warning sign. If the IRS determines that your primary dwelling is actually your winter residence rather than the residence you intended to sell, your entire exclusion could be in jeopardy. Now, let us discuss the second major modification, and this one impacts a lot of seniors who may not even realize they are in the crosshairs. If you have ever rented out a section of your residence, even informally, even just a room through Airbnb or a comparable platform, even just to assist a relative or friend who paid you some modest sum, the IRS has now clarified that any section of your residence that was utilized for rental income is subject to a proportional reduction of your sale exclusion. This is not entirely new as a concept, but the enforcement has gotten considerably stricter in 2026, and the thresholds have shifted. What does that mean in dollars? Let us say you have a residence that is worth $400,000 more today than what you paid for it. That sounds like a wonderful thing. And for most seniors, it represents a lifetime of wise decisions and diligent effort. But if 20% of your residence was rented out for any portion of the last 5 years, up to $80,000 of that gain may now be subject to capital gains tax, even if you are within the general exclusion limits. And depending on your total income in retirement, that capital gains rate could be 0, 15, or even 20%. Add in the 3.8% net investment income tax that can apply to higher income retirees, and you are looking at a tax obligation that could easily be $10, $15, or even $20,000 or more on a residence sale that you thought was going to be completely tax-free. I want to ensure that figure truly registers for you because this is not hypothetical. This is occurring to real seniors right now across the country who are going to sit down with their accountants or their tax preparers this year and discover that the residence sale they planned, the one that was supposed to fund the next chapter of their retirement, is going to cost them far more in taxes than they ever anticipated. Let us continue because the third modification is one that impacts a very specific group of seniors, and it is one of the most misunderstood elements of this entire new regulation. If you have been utilizing a section of your residence as a dedicated home office, and I mean a space you have been deducting on your taxes for business purposes, the IRS has historically required you to recapture the depreciation you claimed on that space when you sell the residence. That has been the regulation for a while. But what shifted in 2026 is that the recapture calculation has been revised, and the rate at which that recapture depreciation is taxed has increased for many taxpayers. Where it used to be taxed at a maximum rate of 25%, the new guidance applies ordinary income rates in certain circumstances, which could push that figure significantly higher depending on your overall retirement income. Now, I realize this is getting into some complex territory, and I want to pause for just a moment and state something important. You do not need to memorize all of this. You do not need to become a tax expert overnight. What you need to do is recognize that these modifications exist, that they likely impact you, and that the wise move, the only move really, is to get yourself in front of a qualified tax professional or elder law attorney before you make any major decisions about your residence. I cannot emphasize this enough. The cost of a couple hours with a professional could save you tens of thousands of dollars. And we are going to discuss more about how to find the right kind of assistance a little later in this video. But first, I want to address something that a lot of you are probably wondering. What if I am not planning to sell my residence? What if I just want to remain where I am, age in place, and eventually leave the residence to my kids or grandkids? Does any of this apply to me? And the answer, unfortunately, is yes. And in some ways, the implications for inherited property are even more significant than the sale regulations. Here is why. Under long-standing tax law, when you leave your residence to your heirs, they receive what is called a stepped-up basis. That means instead of inheriting your original purchase price as their cost basis, they inherit the fair market value of the residence at the time of your passing. So if you bought your residence for $80,000 and it is worth $600,000 when you pass away, your heirs basis is $600,000, not $80,000. If they turn around and sell it shortly after inheriting it, they may owe little or no capital gains tax because the sale price and their basis are close to the same. That stepped-up basis has been one of the most powerful wealth transfer instruments available to American families, and it has particularly benefited seniors who have possessed their residences for an extended period and seen significant appreciation. But the new 2026 regulations have introduced limitations and reporting requirements around the stepped-up basis that you and your heirs need to comprehend. Estate and gift tax thresholds have shifted. The way certain trusts and transfers interact with the basis regulations has changed, and the IRS has increased its examination of property transfers between family members that occur close to the time of passing or that appear to be structured to circumvent taxation. This does not mean that estate planning around your residence is off the table. Far from it. In fact, it makes estate planning more significant than ever. But it does mean that strategies that may have functioned in the past, simple additions of a child's name to the deed, informal transfers, handshake agreements within the family, may now trigger unintended tax consequences that nobody wanted and nobody planned for. Let me provide you a very specific illustration that demonstrates just how real this is. Imagine a grandmother in her late 70s who resides in a residence she purchased 40 years ago. The residence has appreciated enormously. Her daughter has been helping care for her, and everyone agrees that eventually the daughter will inherit the house. A well-meaning family friend suggests that the grandmother simply add her daughter's name to the deed. Now, to make things simpler later. Under the new IRS guidance, that kind of transfer could be treated as a partial gift, triggering gift tax reporting requirements, potentially diminishing the daughter's stepped-up basis entitlement, and in some situations creating immediate capital gains implications. What seemed like a simple, loving gesture could turn into a costly error. Not because anyone did anything improper, but because the regulations shifted and nobody informed them. That is the core of what I want you to take away from this video. The regulations shifted and most seniors, most property owners have no idea. You are not going to learn about this at your bridge club or your church group or your neighborhood association. The individuals who understand this are tax attorneys, CPAs, and financial planners. And unless you specifically seek out that information, it is very easy to make a perfectly innocent decision that ends up costing you or your family a significant amount of money. Now, let us discuss what you should actually do, because this video is not intended to frighten you. It is intended to empower you, and there are real practical measures you can take right now to shield yourself. The very first thing you should do is assemble your documents. Pull together your original purchase documents for your residence, the closing statement, the settlement sheet, whatever you possess from when you acquired the property. If you have made significant improvements over the years, a new roof, an addition, a kitchen remodel, updated plumbing, or electrical, locate those receipts and records as well, because those improvements add to your cost basis and can diminish your taxable gain when you sell. A lot of seniors do not realize that every dollar they spent improving their residence over the years is a dollar that diminishes what the IRS considers their profit. The second thing you should do is make an honest accounting of how your residence has been utilized. Have you rented out a room? Have you operated a business out of your residence? Have you taken the home office deduction? Have you had a caregiver residing with you who paid any kind of rent? Have you listed your residence on any short-term rental platform, even occasionally? All of these things matter, and your tax professional needs to understand them before they can advise you properly. Third, if you have a mortgage, and this includes reverse mortgages, you need to comprehend how that mortgage interacts with a potential sale or transfer of the property. Reverse mortgages in particular have some very specific regulations about what occurs when the property owner moves, sells, or passes away. And the 2026 modifications have introduced new timelines and reporting requirements that both property owners and heirs need to be conscious of. If you have a reverse mortgage and you have not spoken with your loan servicer or a HUD-approved housing counselor recently, that conversation needs to occur soon. Fourth, and I understand I keep emphasizing this, but it warrants repeating. Please consult with a qualified professional, not a friend who dabbles in taxes, not a tax preparation franchise that handles simple returns, not the individual down the street who helped you with your taxes for 20 years and is perfectly wonderful, but has never specialized in real estate or elder law. You want someone who specifically comprehends how the 2026 IRS modifications interact with property ownership, estate planning, and retirement income. You want a CPA who works with retirees or an elder law attorney, or ideally both working together. If cost is a worry, and I understand that for many seniors on fixed incomes, the idea of paying hundreds of dollars an hour for professional advice feels out of reach, there are resources available. Many areas have low-income taxpayer clinics that provide free or reduced cost assistance. AARP offers a tax aid program that connects seniors with trained volunteers. Your local area agency on aging can often direct you toward free legal and financial services in your community. The National Council on Aging has a benefits checkup tool that can help you identify programs and assistance you may qualify for. Fifth, if you are working with a financial advisor or estate planning attorney who has not brought up the 2026 IRS modifications in your recent conversations, that is a conversation you need to initiate. Ask them directly. How do these new regulations affect my residence, my estate plan, and my tax situation? A competent advisor will welcome that question. If they seem unfamiliar with what you are describing, that itself is important information. Now, I want to spend a few minutes discussing something that goes beyond just the dollars and cents, and that is the emotional dimension of all of this. Your residence is not just a financial asset. For most of you watching this, your residence is where you raised your children, where you created your memories, where you feel safe and comfortable. The thought of a government agency having any kind of claim on what occurs with that residence, on the money you receive from it, or on whether your children can inherit it without a tax burden feels deeply personal, and I believe that is completely understandable. But here's the thing. The government is not attempting to take your residence. These are tax regulations, and like all tax regulations, they are navigable. They are manageable. Individuals do it every day with the proper guidance. The seniors who are going to be hurt by these modifications are not the ones who seek out information and take action. They are the ones who do not understand, who make uninformed decisions, or who assume that everything will function the same way it always has. Understanding is your most powerful protection right now, and that is exactly why you are watching this video. Let me also take a moment to discuss something that comes up constantly in conversations with senior property owners, and that is the question of timing as it relates to capital gains tax rates themselves. A lot of individuals are aware that capital gains tax rates depend on your total income. If your income is low enough in retirement, you may actually qualify for a 0% capital gains rate. That sounds wonderful, and for some seniors, it truly is. But here is where planning becomes so essential. If you sell your residence and receive a large lump sum, that money counts as income in the year you receive it. Suddenly, your income for that tax year could spike dramatically, knocking you out of the 0% bracket, potentially affecting your Medicare premiums through what is called IRMA, the income-related monthly adjustment amount, and possibly even affecting the taxation of your Social Security benefits. These are all interconnected systems, and a decision about your residence can ripple outward in ways that most individuals never anticipate. A competent tax planner will examine your entire financial picture, not just the residence sale in isolation. They will consider installment sales, charitable strategies, timing the sale to minimize your overall tax burden across multiple years. These are real instruments that real individuals use, and they are available to you if you seek out the proper guidance. I also want to address something for those of you who have a spouse or a partner. If you own your residence jointly, both of your names are on the deed, and your planning for what occurs with the residence needs to account for both of your situations. What occurs if one of you passes away before the residence is sold? What occurs with the stepped-up basis? What are your options in terms of how title is held? Joint tenancy, tenancy in common, community property in states that recognize it. These are not abstract legal questions. They are real decisions that can have tens of thousands of dollars of consequences, and they need to be part of your conversation with a qualified professional. And for those of you whose adult children have been involved in helping you manage your residence, whether that means they have been contributing to the mortgage, helping pay for improvements, or simply managing the property while you travel or receive care, please be conscious that those financial arrangements can create unintended legal and tax implications under the new regulations. Even the most well-intentioned family financial arrangements need to be reviewed in light of what shifted in 2026. There is one more thing I want to address before we conclude, and it is about timing. One of the most common errors I observe individuals make, and this applies not just to residence sales but to financial decisions generally, is waiting too long to act. I comprehend the instinct. Change is uncomfortable. Tax conversations feel complicated. It is easy to say, I will handle that later. But with the 2026 IRS modifications, later can be very expensive. Consider what procrastination actually costs in a situation like this. Let us say you are planning to sell next spring and you assume everything will function fine the way it always has. But because you did not consult a professional before listing, you did not understand to document all your residence improvements. You did not understand that the room you rented on Airbnb 2 years ago would diminish your exclusion. And you did not understand that the way your deed is structured creates an unnecessary tax burden. By the time your accountant discovers all of this, the deal is already finalized and the tax obligation is already locked in. That scenario plays out every single day across America, and it is entirely preventable. Prevention is always cheaper than correction when it comes to taxes. And even if you are not planning to sell anytime soon, the estate planning implications of these regulations mean that every year you wait to update your plan is another year of potential exposure. Wills and trusts that were drafted 5 or 10 years ago may not reflect the current legal environment. Beneficiary designations that made sense before may not be optimal now. The residence is often the largest single asset in a senior's estate, and it deserves the most careful, most up-to-date planning possible. I started this video by telling you that this is urgent. I hope by now you fully comprehend why I feel so strongly about making sure seniors across America have access to this information. Not because you should be panicked, but because you should be educated and proactive. You have worked hard for your residence. You have paid for it. You have maintained it. You have built memories in it. You deserve to have it function for you and for your family in the most effective way possible. These new IRS regulations do not have to be a threat. With the proper information and the proper guidance, they can be navigated, but you have to take that first measure. So here is your homework after watching this video. Number 1, assemble your residence purchase documents and improvement records. Every renovation, every upgrade, every capital improvement you have made over the years adds to your basis and diminishes your taxable gain. Number 2, make a list of any non-primary uses of your residence over the last 5 years. Number 3, schedule a conversation with a qualified CPA or elder law attorney this week if possible, not next month. Number 4, if you have a reverse mortgage or any complex title arrangement, contact your servicer or attorney today. Not after the holidays, not after the summer, today. And number 5, speak to your family. Ensure your spouse, your children, whoever is going to be involved in the future of your residence, understands what is at stake and is part of the conversation. Family meetings about financial and estate planning feel awkward sometimes, but the seniors who have those conversations are the ones whose families are shielded and prepared. I want to express my sincere gratitude for watching this all the way through. I understand it was a lot of information, and some of it was heavy and detailed, but you showed up, you paid attention, and you stuck with it. And that already places you ahead of the millions of seniors across this country who have no idea that any of this has shifted. Share this video with a friend, a neighbor, a sibling, a fellow retiree, anyone you know who owns a residence and is over 60, because this information is too significant to keep to yourself. And if this video helped you, if it provided you something useful, something that made you feel more prepared and less in the dark, then do me one small favor. Press that like button, leave a comment below telling me what your single biggest takeaway was, and subscribe so you never miss another significant video like this one. Your financial security matters deeply. Your residence matters. The legacy you leave for your family matters. I am not an attorney. This content is for educational purposes only.